Good afternoon and welcome to Financial Wellness Month at Covenant Living Mount Miguel. My name is Ingrid Prater. I am your local financial service representative for Covenant Trust Company. I serve all of Southern California area as well as Covenant Living Mount Miguel. Covenant Trust is the preferred provider of financial services for the Covenant Living communities nationwide. We specialize in investing, money management in retirement, estate planning, such as trusts, wills, and powers of attorney, as well as charitable giving options. Today, we are hosting a presentation on maximizing your retirement income. Our speaker, Linda Kanter, is a consultant with Covenant Trust Company. She has spoken at Mount Miguel before and is back by popular demand. She is credentialed as an enrolled agent, the highest credential the IRS awards. She is recognized as a tax expert. So please join me in welcoming Linda Kanter.
Good morning, Covenant Living. This is Linda Kanter, president and owner of Kanter Tax and Trust here in Naperville, Illinois. We are just outside of Chicago. I'm coming to you today because I want to talk about tax. We speak tax. It's so much fun, and I'm hoping that through this seminar we'll have some good learning opportunities for you. For those of you that don't know me, I'm an enrolled agent. I've been practicing for many, many years. Before the Internal Revenue Service, and that's what an enrolled agent is. It's a special designation. It's a federal designation. I can practice anywhere and represent taxpayers before the Internal Revenue Service. And what does that mean? Well, we prepare tax returns, which is very important that we do every year. We, respond to correspondence if you need an installment agreement, but we also do some tax planning. We work with Covenant Trust and do tax planning with some of their clients. And why is that important? Because I think you need your money versus the IRS. So we're going to be talking about hopefully some potential savings for you today in the seminar. And the other things that we do, which is we're doing now, is we're actually doing outreach to talk to people regarding taxes. So we speak tax, and we're hoping that you'll learn a little bit about it and start learning how to speak tax too. So let's get started. Where are we going? We're heading over here to the story of Charlie and the Chocolate Factory. For those of you that remember the story, Charlie got the last golden ticket to get into Willy Wonka's factory. And he's singing with Grandpa. I'm not going to sing for you, but I like it. It says, "'Cause I've got a golden ticket, I've got a golden chance to make my way. And with a golden ticket, it's a golden day." I'm hoping today is a golden day for you. We find something for you that you can use on your tax return for some tax savings. So let's get started. Where are we starting from? Well, I just want to cover a couple things from you. A couple years ago, I came across this survey nationwide, Retirement Institute. It's online if you want to read it. Came across some very interesting things. They did a survey and they found about 40% of the retirees did not consider taxes on how that would affect their retirement income. And look at this. They have an opportunity lost to save an additional 6 worth of income in retirement. So losing 6 years of income to taxes, that's a lot of money. Huge amount of money. Over 70% of them admitted that they were somewhat aware or not knowledgeable at all about tax planning. And that's what we're going to be talking about. In my practice, when we talk with someone and we do a tax return, we give that back to them and we talk about where they are, what could be good, what could be different. And I think that's different than if you go to a tax preparer or get your return prepared and they say, "Here's your information," and you get it back. There's no conversation. We have conversation with our clients. Why? Because it's too much money. Taxes are a lot of money, a good percentage of your income. So if it can be in your pocket versus their pocket, I think that's all the better. And if, on the same survey said 47% of the recent retirees wish they had a better understanding of how their income was going to be taxed. Again, hence why we're here to talk about some of those things that could be to your advantage. We're going to start with the standard deductions and itemized deductions. I know a couple of years ago, and you must be familiar, where you said, gee, I'm itemizing, I need all my medical, I need all of my receipts, and you come to find out and you go, whoa, wait a minute, the standard deduction has changed so much, I'm not itemizing anymore. So if you're looking at, for 2019, for example, the standard deduction for someone who is married filing joint, if you both were over 65, was $27,400. So what does that mean, the standard deduction? That means I need $27,401 in order for me to do a Schedule A and to have any advantage of itemizing. Well, what does that mean? They already give you $27,400 free, meaning you just put that on your tax return and you take that off and you have your taxable income. People are not meeting those standard deductions like they were in the past. Hence, you're not itemizing. Now, if you're under single and 65 or older, it's $14,050. Again, a number that's higher that most people are not meeting or they could meet. Now, remember, these amounts could change after 2025. This is only good through there, or unless we have changes in the meantime. But for right now, this is what we're dealing with. So sometimes it's not beneficial for people to be itemizing, but there could be some reasons you'd want to itemize. Now, before we get started, I just want to bring you to some things on your tax return for 2019. If you were with me last year when we came out, we actually showed you a couple things, some terms, and some places on the tax return to circle. So one thing that may be helpful for you is to get your tax return and circle these two numbers that we're going to be talking about during this session. One of them that's very important here is line 8B, and we're going to talk about it. We always hear about it. It's called adjusted gross income. AGI is another way that we speak with it. Your adjusted gross income is on 8B this year, and this is what we use when we itemize and we say you've got to be 7.5% of your AGI. That's the number we're looking for. The other number that's really important that we'll be coming back to that I want you really to circle is 11B. Knowing what your taxable income is going to be very, very important. We'll be able to look at your tax rates and figure out where you're at and how much you're paying. And that's the number that we're going to be looking at. So I would encourage you, whether you do it now or you do it a little bit, pull your tax return out and get familiar with what is my adjusted gross income? What is my taxable income? We'll be coming back to this slide later in the program, but again, I just wanted you to see the tax return this year in 2019 slightly changed. I would expect 2020 to have some changes too. Of course, that return is not out yet. So the first item up for bids here we're going to be talking about is your Schedule A, your itemized deductions, and we're going to be looking at the medical expense. When you enter one of the Covenant Living communities, part of the entrance fee is considered a medical expense. So we want to be sure that we take advantage of anything that we could if that should happen. So we're looking here, we're going to start on your Schedule A and just refamiliarize yourself with this area here at the top, and that's your medical deduction information. So remember that medical expenses, if they exceed 7.5% of your adjusted gross income, which we just talked about, and in this case, 17,000 times 7.5% is $1,275. That's the amount you cannot deduct. It's subject to that. So you take the line 1, what your medical is, and you subtract line 2, and you come up with your $69,000. And what are some examples of medical expenses that we have? We have like hearing aids or doctor visits, your health insurance premiums. What about your Blue Cross Blue Shield, your Medicare supplemental premiums? Nursing home expenses, as long as it's medical related, co-pays, what about prescriptions? All of those are medical expenses that we would consider medical for this purpose. So the first thing we're going to talk about are the medical deductions generated from possible entrance fees and monthly service fees. So the question becomes, where do I find these amounts? So if you have gone into one of the Covenant communities this year in 2020 and you say, gee, how would I know? Well, on the next pages, I have some sample letters from Covenant Village of Northbrook. Again, it's a sample letter. You need to get the one for your own that will give you the information on the medical expenses that you're able to deduct for your entrance and your medical expense portion fees. You know, how would I get an idea? So one question would be, I came in 2020, how would I know what that expense might be? These letters come out in January following the year you enter. So the 2019 entrance letter, which is in the following slide, came out in January of 2020. So if you've come in 2020, your letter will come out in January of 2021. And you go, whoa, wait a minute, that kind of defeats the purpose. Well, it does, because we can't, or they can't calculate this until the end of the year. It's over. So I have an idea. What I tell clients is go to the marketing department and say, can I have a letter from my contract from last year? It gives you a sense of something instead of nothing that we can be at least using. You'll have an idea. It's not going to be exact, but you're going to find out, you know, it's not $500, it's X number of dollars. And so for tax planning, it's going to be something very important that we take a look at. So go back to the marketing department and get it. But again, the slides here again are a sample, so go and get yours. But it's going to give us an indication. So here's one, again, here's a sample. And remember, I want to say this is a sample of a specific contract from Covenant Living of Northbrook. So go to your community, again, go to marketing and say, I came in this year, what was last year's? You see, this is the entrance fee for 2019, done in January 2020, and see if you can get this year so we could kind of figure what the deduction might be. Could it go up? Could it go down? It does, but at least we know, at least in this case, just want to say, if you went into Covenant Living of Northbrook last year in 2019 under the 6010 contract, double occupancy, the medical deduction was $70,681. So out of your entrance fee that you paid, when you pay it, part of it is considered medical because there's medical facilities on the properties. So in the case of the year that you enter the facilities, you're able to use this as a deduction. It's a huge deduction. So let's talk about how this works. One, it's a one-time fee, well, thank goodness, right? You only have to pay it once to get in. So remember, you are only able to deduct it one time, and it is in the time and the year which you pay this amount. The other thing that's really kind of cool about this is that this could help reduce your tax liability. If you had a $70,000 deduction against your income, think about how that would reduce your tax liability. Huge. Would you be itemizing? Sure. It's more than $27,400 if you're married. So, you know, I think that's a huge benefit. The other thing it may allow you to do, if that your income isn't that high, you might be able to generate some additional taxable income tax-free. Well, what does that mean? Let's take a look and see what happens. I've got a scenario here for someone who is married filing joint. Both of them are over 65. And I've got some income. I just made this income up. $2,000 of interest, $2,000 for dividend, $10,000 for retirement. Average Social Security at $24,000 a person, it's $2,000 a month. And I said, geez, what would happen if I had a medical deduction of $70,681? So here's my scenario. Okay, I'm going to do some tax planning. What happens? In this scenario, guess what? They have no tax liability. You're going, yay, I beat him. I don't have to pay anything. Yes, yes, yes. And I'm saying, whoa, whoa, back this up. Whoa, 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 whoa. Take a look here. We didn't use a full itemized deduction. The taxpayer can take an additional $28,000 more of income, non-Social Security income, and still have zero income tax liability. Why? Because their deductions are larger than their income. So in this scenario, I would be looking at an additional $28,000 of income coming from someplace. And if you did and still paid zero tax liability, look at your tax savings this year. It'd be $4,300. You take out $28,000 tax-free, provides you $4,300 in tax savings. That's your vacation. The government paid for you. In addition to your entrance fee, Covenant Living, they have monthly service fees, and in there, part of it is for medical is what you pay. The medical deduction that you have may reduce, again, your tax liability and, again, generate or allow you to generate more tax-free income. So how does this work? I'm going to use the same scenario that I had before, so we keep it the same. $2,000 of interest, $2,000 of dividends, $10,000 of retirement, and I have $48,000 in Social Security, $24,000 per person, and a medical deduction of $38,410. Where do I get that from? I'm looking at the Covenant Living again. It comes in January for the prior year, for 2019. This person just has to be in the assisted living space and under double occupancy. $38,410 would be their annual fee that they could deduct for medical. Now you see there's other ones here where if you're in the residential, it's $467 or $645. So you just find yours here. I just said, listen, I'm going to use the double occupancy here at 38. But take a look here. If you get into skilled nursing, $74,000 would be your medical allowance. That's huge. And for some tax planning, really see somebody, because that could really be really helpful. You could get some tax-free money out. So if I had that, what would end up happening? In this scenario, the taxpayers, again, their deductions exceed income and they don't pay any federal tax, but they've lost some opportunity here. Take a look what happens. They could have taken out $11,500 or had that more income and have zero tax liability. Zero, nothing, nada. And I'm going, whoa, wait a minute, I think that's too much. So we put together a scenario here, the sweet spots, based on our previous examples, because sometimes it's easier to see it in a chart. So if we find married filing jointly, and we have an entrance fee, and we have Social Security, and you say, gee, I don't have any interest income, or I don't have any retirement income. Okay, so then this other income section here says, take a look at it. I'm using $48,000 for Social Security. I'm just using that as an example. This other income could be any other income that you have. Interest, dividends, retirement income, or maybe you have all retirement income and no interest in dividends. If I'm looking at $48,000 and $42,000, that's the sweet spot. That gets me zero tax liability, zero. If I'm looking at the monthly service fee at $38,000, the same thing, $48,000 for Social Security. And then guess what? I could take another $25,000 from anywhere else and still have a zero tax liability. Now, the things that I didn't consider in here when I went through it, I only considered the medical. So you could have additional deductions. Perhaps you sold your house and you have some real estate expenses. That would reduce your income too, which again would increase other income. If you had charitable deductions or contributions, I should say, not deductions, that would also increase your Schedule A or itemized deductions, and you may have some more room for some other income to come out tax-free. So the bottom line here is this is a huge opportunity, should you be going into the communities, to have someone take a look at your tax return and say, where are you? Where am I? Do I have any opportunities? And this is an opportunity, again, you saw on the first slide, it's one time for the entrance fee. Without that, for the one-time entrance fee, you lose it. You can't carry it into another year. So using and creating some extra income in the year that you enter is really what needs to be happening. So talking it over and seeing what is it that I can do. Here we go. We're considering, so what can I do? I've got here generating additional income. What does that mean? So you have your typical income, your interest, your dividends, and your retirement. You go, okay, what do I do? One thing that I would like, and I look at too, is do I have any extra pension money or IRAs or annuities? I would typically look for it there. So if you were short $10,000, the 42, I'd say, let's take an extra $10,000 out of your IRA. Why? Because there's no step up at death. What does that mean? IRAs, pensions, and annuities are taxed at the highest rate, their ordinary income. When someone passes away, an annuity and an IRA is not stepped up at death. So another reason to do that. So again, what is step up at death? I'll give you an example. If I purchased Apple stock, and I purchased Apple stock at $50 a share, and I sold it today, I'm still living at 150. 150 minus my cost basis of 50, I have a $100 gain I put on my tax return. That's my gain, I pay tax on it. But if I die and my children inherit this and I paid $50 for this stock, on my date of death, that value of the stock gets stepped up. The cost basis goes from 50 to 150. So if my children decide to sell it exactly on the day that I pass away, which rarely happens, but if they did, there wouldn't be any capital gain. Why? Because the cost basis is 150 and the sales price is 150. If they sold it a month after passing and that stock went up to 160, their cost basis is $150. So they pay tax on $10 a share. That doesn't happen on IRAs and annuities. There's no step up. So it's a good way to get some tax-free money and again, move that money around. I'm not saying spend it. I'm saying, well, if we can get money out tax-free and put it into your investment account or into your savings accounts, why not do that and not pay any tax on it? In very limited cases, sales on the gain of the personal residence is good. Now remember, with a house, for someone who is single, you receive a $250,000 exclusion. What does that mean? That means if I sold my house and my gain is $250,000 or less, I pay no tax on it. Right now, no tax. So guess what? Is that going to increase your taxable income? It will have no effect on your return. The same thing with someone who is married filing joint, only their exemption goes to $500,000. So if your gain is less than $500,000, that's not going to help you. Now I've heard of some people come to me and say, yeah, my house, they want the land, I'm selling it for more than a $500,000 gain. Then there is a possibility to consider that this money be, say, oh, I've got this money and we've got this extra cash that we've raised to offset the deductions. Other things to consider when we're looking at different things here are possibility of surrender fees. If you are in an annuity, one thing to look at is if you're going to take money out, do I have a surrender fee? Do I have to pay to get that money out? That's all in the mix of things that we look at. There's several things. There's just not an income thing that we look at here too. The other things we'd be looking at too is, what are the state taxes? I'm speaking today basically on the federal level. I am not talking about state taxation. The states typically are cheaper than the federal, but it is something that we would look at. What would that do to your income tax liability for the state? on annuities, especially because in some states they're taxable, some are not. Taxability of Social Security could go up or down based on income. Remember, Social Security can be taxed up to 85% of what you bring in based on income. So maybe your income in prior years was low and you weren't taxed on it. We would calculate that too and try to figure out where is the sweet spot. The cost of Medicare premiums could go up if you sold some things. We have the Medicare premium charts. Typically, it would go up for a year. If you went over the threshold, it should come down the next year. But again, these are things that are all looked at when you consider in the mix. This is something, again, for tax planning. Everybody's tax return and situation is different. All of them are different. So sitting down and saying, what are the pieces? And that's what I like to do. I like to take the tax return and say, how do all the pieces fit in? What are they doing? What is it for you that we can do? Or what can you do for yourself by kind of tax planning? And the last thing would be the cost of tax preparation. I got to tell you, my tax preparation fee is not $4,300 like the tax savings would have been in the first slide. We do have tax preparation costs. They're very reasonable and considering what you're getting in return. So please, we can talk about tax preparation costs, but there is a cost for tax preparation, tax planning, but it may be worth the cost to go ahead and have somebody kind of look at and give you some guidance through that. Other things to consider is possible future tax law changes. If we have some tax law changes coming up, we need to look at that. We do have an election coming up this year, so it's going to be interesting to see after November what happens. I'm expecting a lot of activity between November and the end of the year, just simply because whoever wins, we may have to make some changes before the year end. Bundling and maximizing your itemized deductions. So if you go into the community and you know you're going to itemize, perhaps this is the year that you consider making your charitable donations, or you say, I'm going to make my donation to the church this year in December. My January one doesn't make a difference if I'm not going to itemize next year. Maybe you take that January one and you put it in December because you're going to itemize this year. So that's something to think about. I'm itemizing, so maybe I might be more charitable, or I might have, for medical, I'm going to go have that extra checkup in December. Or I'm going to get that extra pair of glasses. Why? Because I'm itemizing. For those of you that haven't had a chance to take advantage of this, and it's in the last 3 years, you may be able to amend your return to decrease your tax liability. You certainly wouldn't be able to, quote, sell something or generate more income to offset it, but you could amend your return to decrease the tax liability. That's always a possibility. And by claiming the medical expense, you're reducing your taxes. And why do we care? Because here's the thing, this is your money. So you have more money to live on when we're tax planning. And I think it goes back to the first slide where we said 40%, so we could lose 6 years of income. That's too much to lose. You need that money to be living on. Or the other thing too, you could pass it on to your beneficiaries or your charity should something happen to you. So I think it's something really to consider, coming on into the community to have this checked out. Moving on, second subject. Oh, this is kind of cool. Qualified charitable distributions. This is really a good way to fund the charities in light of you might not be itemizing. So we're going to talk about making a QCD, is what they call it, from your IRA, individual retirement account. So who is it? This is for somebody who is 70 and a half and older. Okay, and you can have an inherited IRA, but you've got to be 70 and a half too before you can make the distribution. It's you, the beneficiary, has to be 70 and a half. Well, how does it happen? It happens, I say, I want to donate $1,000 to my church. So I'm going to call up my custodian of my IRA and say, I'd like to take $1,000 out of my IRA and transfer it to the charity. How much can I do? $100,000 a year per person. So a married couple can do $200,000 out of their IRA, and it counts towards your required minimum distribution. And why would you do it? Because you're doing it tax-free, as long as you have no other goods or services received other than religious and tangible benefits here. And also, too, guess what? again, it's tax-free. So if you're going to use your required minimum distribution and you're donating anyway and you're not itemizing, you could reduce your taxable income through QCDs. So let's take a look and see how this works. I've got an example here, and I like this first one here where I'm saying it's without the QCD. So I'm just assuming here you have income before IRA of $200,000, and you're required to take out $10,000 from your IRA. So remember, AGI, adjusted gross income, is $210,000. Now let's look at your Schedule A. You have some state and property taxes. You have your $10,000 to charity, so you have $20,000. Are we going to itemize? Our standard deduction is $26,600. Yeah, I don't think we're going to itemize. No. Isn't it better to take the standard deduction because it's more? It is. It is more. So we're going to take this, correct? And here's our taxable income. Now, if we go with a qualified charitable distribution and we say, I'm going to take this $10,000 and donate it directly from there. Look at my AGI as $200,000. My taxes are 10, right, if I'm going to go to my Schedule A, and I have 0 for charity. Why? Because I didn't do it. I didn't write the letter. My IRA custodian did it and sent it right to the charity. Look at that. I have a $10,000 in my Schedule A, and my $26,600 is still higher. And this was based on last year's standard deduction, not on the 2019, by the way, in case you're looking. So we have $173,400 is our taxable income. Look at the difference there, a $10,000 difference. You're in the 24% bracket. You're saving $2,400. So by just changing how you donate, you're saving $2,400 on your tax return. You didn't increase it. You didn't decrease it. The charity's still getting the same amount of money. But look at your tax savings. It's huge. Things that you need to know about this is that you need a written acknowledgement from the charity. So just having the information from your custodian, the person holding the money, is not good enough. The charity's got to give you and provide you a statement. And it's got to have the amount. How much did you donate? And the date of the donation. Something very important that must state that no goods or services were received in exchange for the donation. Absolutely. And you need to receive it before you file your tax return. You know, IRS has not changed receipting in many years. The courts are real clear about these things in bold. Okay, so if you say, oh, file my tax return, I'll go back and get the letter. IRS audits you, they're going to go, sorry, you know, you made the donation, but you should have had that letter in your hand beforehand. So in our practice, we make sure people have those letters. We look at them. You know, some of them say no goods or services, or they don't say that, I should say. We make them go get them because this is important. If we want to win with IRS, I want to have all the goods. So we put a sample letter here for you. You know, it's the individual's responsibility, you, the taxpayer, to receive this from the charity. A lot of people say, well, the charity didn't give me one, so we'll, you know, go back during the tax season and try to work with the charity to get one. Sometimes it's harder than others, you know, if they don't want to give you one or it's hard. I've had people say, I'm not going to donate anymore, but this is really up to you to make that decision. But the key things here that I've got here is how much is the gift? It comes from your IRA. You know, it's a qualified charity. Now remember, you can't expect just because you say they're a charity that they're recognized by the Internal Revenue Service. So just be careful. You can go to the irs.gov and there is a section under there under charity, and you could put the name of the charity in there or the employer ID number and see if they're recognized by IRS. one of the things that I like, it's not required, but I like this here. This is what I was just talking about here about this EIN. It's called an employer identification number, and it's assigned to a charity when they open on up. What I've found is that some charities are not listed on the IRS website because they are under an umbrella of a larger charity, so we wouldn't find them. So I think it's a wise idea to have it. I think it would be good if they looked it up, we looked it up and couldn't find it. Could be a problem, but it's not really necessary, but I like it if it's on there. Again, no goods or services. This means no tote bags, please. Nobody, nothing. You cannot receive anything in return for this donation. If you did, it negates the whole donation and it becomes a taxable event. So please, please, please be sure, nothing in advance, nothing there, nothing in exchange, no dinners, no tote bags, no nothing. So just to sum up, this is a summary here of what we've got here. No gift bags again. I keep going back there. No tote bags, but it is a great thing to be doing. So please consider it. I do want to say one thing. Let me go back one slide. That if you have a 403B or you have a 401k, you are not. You can still do a QCD. There's a couple more steps. So if you have those types of products, see your financial service rep. They can help you. We can help you get to that IRA situation. I'm not covering it here, but you're not excluded. All right, looking on, we're looking at the 2020 tax brackets I put up here for you so you could kind of see where you are at. If you take a look at 2019, they were slightly adjusted, but I really wanted you to have them so you could kind of see for tax planning. How do these tax brackets work? I just want to explain it. So let's take a look at a married couple here on the right, the lower right down here. You see my button here? I'm going to put my cursor on. Hang on. Got it right here. Married couple. If your taxable income, and remember we said taxable income is on your tax return. You saw where your taxable at the bottom of the last page on line 11B. If it's $19,750, remember you're taxed at the 10% rate. And look, that's the lowest of all of them. And then it goes up. So the next bracket is 12%. And between $19,751 and $80,250, you're going to be taxed on 12%. So it gradually goes up. So the first 19 is at 10, in between here is at 12, the next one is at 22. So you can kind of see where these brackets are. I think it's important that you understand them so that you kind of can do some planning too and taking a look at where you're at. I like this here. When I go to the next one, I just wanted to give you a visual. One of the things that we talk about too is that when we're planning is, when we're married, we could be in different tax brackets. So if we're looking at, for example, down here in the $100,000 range, and you say, as a married couple, I'm in the 22% bracket, but should my spouse pass away, kind of look what happens. At that 100,000, you go in the 24% bracket being a single person. So one of the other things that we like to consider is saying, okay, let's look now, let's look for the future. What can we do now to make it lesser for the surviving spouse when they go possibly into a higher tax bracket because they're going to be single? Again, something that we think about. So I wanted you to have this information so you could kind of see the differences in the brackets, why we might be suggesting one thing and not another. All right, changing the subject. We're going to go to the Secure Act that came into effect in January of this year. There's one thing really that I want to talk about to finish this on up is the IRA and some of the requirements. So with the QCDs and the RMDs, things are changing. QCD is not changing, but what has changed? Remember the QCD, is at 70.5, and the required minimum distribution was at 70.5. Now they changed the required minimum distribution to 72. But remember, those are two separate items. The QCD is still at 70.5, RMD is at 72. Okay, required minimum distribution. Other things that can happen, you can contribute to your IRA after 70.5 now if you're working. That's going to be kind of interesting. But this number 3 is one that really we need to be talking about too when we're looking at planning now. Because for the stretch out IRAs or for IRAs after somebody passes, you only have 10 years to take the money out. It used to be we could take, if someone passed before last year, we could take the money out over our lifetime. So if you passed it down to your child and they were 40, they could take it out over their lifetime. Now, if you pass away and your child gets it and they're 40, they have 10 years after the date of death to take that money out of the IRA. That could substantially change their tax bracket and where they're at, because it's going to be at their tax rate. So I think this is something really I wanted to talk about today, just to kind of get you thinking about it and figuring out how we're going to deal with some of the Secure Act. The CARES Act also came into effect this year and waives all the required minimum distributions for 2020. So if you are required to do that, you are not required to do it in 2020. Okay, this applies to original owners and also anyone who has an inherited IRA. So I got to thinking, I thought, oh my gosh, this is cool. There's an opportunity here. There could be an option, because now we have this 10-year, we got to take it out over 10 years, and that's a non-spouse. A spouse is different, but I'm looking at non-spouses. Here's an option to maybe convert some of our traditional IRA to a Roth during 2020. Why would I even suggest that? Because you cannot convert. Remember, convert is what I'm talking about here. You're not working, we're converting. You can't use your required minimum distribution to convert to a Roth. But if we don't have one this year, I'm just saying, maybe there's a thing that you might want to think about. Why? If I took money out of my IRA, paid tax on it today, and moved it to my Roth, remember your Roth generally grows tax-free. It's tax exempt if the requirements are met. Your beneficiaries would have 10 years to take it out, but remember, they take it out tax-free. So is it worth it maybe to think about the conversion this year? So converting from a traditional to a Roth, the amount converted is income this year. Okay, so it's your regular amount. So you consider what would have been your RMD. A lot of the tax returns we did the estimated taxes based on required minimum distribution because we didn't know better. So taxes could be paid, but guess what? You were able to move it from one to the other at a lower threshold. So it may be a great option in 2020. Another thing to think about too is the micro conversions. You can do it over several years. And here's one thing that we were taking a look at. We were looking at some people and we say, geez, I'm paying no tax, yahoo. But here's the thing, if you're paying no tax and you have some IRA money, one thing to think about is a couple things. Do I need money in the future? If I'm paying no tax now and I can take out as a married filing joint $19,000 and pay 10% tax on it, the lowest bracket ever. One thing you might want to do is think about, wow, maybe I might want to take some of that IRA money and convert it to my Roth and pay the 10% tax. Why would you do that? Couple reasons. One would be possibly you might need it later on. And if you needed more than $19,000, you're going to be in the 12% bracket and so forth. So as long as you keep taking money out of that IRA as you need it, if you needed it, it could be taxed at a higher rate. So you could be creating this nest egg in an investment account, retirement investment account, or in your Roth account if you chose to put it there, and use it at a later date and pay less tax on it right now. What happens if you lose a spouse or a partner? It could be that they're going to go into a higher tax bracket with your required minimum distribution. So if we reduce the IRA by making these conversions, guess what? Maybe we can keep them in a lower bracket. or you're paying tax in a higher bracket if you're going to do the conversion. Now, the tax savings also are magnified now that the 10-year rule is in place. I have found many clients' children in a higher tax bracket than their parents. And the parents are going, I'm willing to pay the 24% because my child is in a higher tax bracket. So they're converting it into the Roth because they don't need any more taxable income come the time the death of the parent. So these, again, are all things to think about. And again, the last thing, we would also consider the impact on Social Security income and Medicare premiums. If it's such that, it's going to increase your income, we want to know everything that could possibly happen. If you took this distribution, would it increase your Medicare premiums? Would it not? All of those things we would take into consideration when, we were. Okay, to give you an example of what I was speaking about in the prior slide, we're going to talk about a couple here whose taxable income, remember taxable income prior to conversion is $50,000. They're married filing joint, and we find them in the 12% rate up to $80,250 of taxable income. The client's daughter's in the 22% bracket. So you can see right here the difference. Mom and dad are in the 12%. The client's daughter, is in 22%. There's a 10% difference in the bracket. So if the daughter inherited this IRA money, she's going to pay 10% more than their parents right now. Would that even, does that make sense? So let's continue and see what happened here in our scenario. The client is thinking of converting $30,000 and stays just within the 12% bracket. Pretty good idea. Uses the whole bracket up. Correct? Still stays in 12%. What is the savings? The result is a $3,000 tax savings for the year since the client's in the 12% bracket and the daughter is in the 22% bracket. Also, there's many more savings because remember, when you put that into a Roth, doesn't that grow tax-free forever? So it's exponential. It's a huge thing to do. So these are things to think about when you're thinking about, do I want to do a Roth conversion? Does this mean mom and dad can't get a hold of the Roth money? Absolutely not. The other thing too, think about it. If the husband or wife pass away or the partner passes away, they're paying in the 12%. Maybe then when the other spouse passes away, that the first spouse or the spouse remaining is going in the next tax bracket, which is the 22% bracket, being single. So this could be good for a number of reasons. Here's another example that I wanted to do. Again, and this actually happened. One spouse passed away during the year and the other spouse is the executor and married filing joint for the year and had taxable income of $70,017. Remember, it's taxable income. I did give you the tax tables, so you have them. And here's what happened. The question is, should the taxpayer take another $10,233 in the year of death, thus using the full 12% bracket? Well, here's another thing we considered when we sat down. I sat down with the client and I said, next year the taxpayer will be single. Taxable income on her own is going to be $42,744. She'll be in the 22% bracket by $2,619. So she's hopping a bracket. Notice it's a 10% increase there. So my question is, do we want to use and take out $10,233? We can convert it. We can put it into their investment account and pay 10 or 12% on that money. Or in the future, do we want to be paying partially 22% on it? Or it could be all of 22% depending on if the income goes up or down. So in this year, the spouse decided to take the $10,000 out. Why? Because it was at a cheaper tax bracket. So these are things, again, to consider throughout the year. Basics on Roth, remember convertible accounts. You can do the 401ks, profit sharings, 403b, 457 plans. Those aren't automatic. You may have to get them to the IRA, but your financial service rep can help you understand what it is and how to do that. Non-convertible accounts, inherited IRAs, educational IRAs cannot be converted. Finally, I just have some public service announcements for you. IRS will never contact you by phone ever. No, 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 they won't. So please do not give them any information over the phone. Not okay. Another scam is we're getting fake notices. Just be mindful of grammar errors, errors in spelling. If they ask for the checks to go to the IRS, this is interesting. Remember we used to write those out? This is the IRS. No, 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 no. Now it's Department of Revenue. Why? Because the IRS, this is interesting. Who would have thought about this? They changed it to this. Mrs., and these are agents, Mrs. Smith. So they stopped that a long time ago going to the IRS. So if you see that, it could be a scam. So just be very careful when you're getting that information and have somebody look at it. Lastly, I hope it's been a golden day and that you've learned some things here. I know that it's fast. There's a lot of information, a ton of it out, and I could only do so much in the seminar for about an hour. I'm not at campuses this year. However, what we're doing with your financial service reps on the campuses, I'm offering virtual appointments. If you'd like to talk with me and your financial service rep, have your tax return there. We can take a look at it, give you some suggestions for tax savings, tax planning. I will make myself available. I've given the information to the financial service reps when I'm available. I'm happy to do a virtual call. I think this is so important for seniors to be looking at how can I save money. And, you know, it's not only for you. I mean, we've got to live today, but also for the future, for your spouse, possibly for, again, your beneficiaries and the charities that you're interested in leaving money to, if that's your plan. But again, I'm all about tax savings. So I'm hoping that you found something today that's been useful to you. If you have any questions, you have my email address is listed here on the slide, the last slide here. Linda@cantortax.com. I would encourage you also to reach out to Covenant's financial service reps. They're great people. They know how to get a hold of me too. Again, we can do a virtual call. We could do a phone call. The thing I like to do is get this done during the tax season because sometimes after the year is over, there's not much, if anything, that we could do. So please don't hesitate. I'm glad that I'm here. I'm so happy to have this opportunity to talk to you and share some of my knowledge and things that I've learned over the years, and look forward to doing more of these. Again, thank you for having me and have a good day.
Thank you for joining us today for Linda Kanter's presentation. If you have any questions about the material covered today or would like a copy of any of the slides she discussed, please give me a call. My number is on the screen, 847-583-3276. Also, my business cards are available at the front desk here at Mount Miguel. If you would like to schedule a virtual meeting with Linda to discuss some tax savings scenarios specific to you, please give me a call and I will add you to her schedule. I hope you found the information shared today helpful, and I thank you for joining us.